Planning points obviously offer themselves where there is a wild disparity between tax rates. And here we have corporation tax low and lower and income tax, national insurance high and high. If you had, for example, a property investment business, which you're conducting in your own name, or ideally in the name of you and your wife, and it's throwing off huge amounts of rental income, which you do not really want. You don't want to pay 50% tax on it. You don't really need the income. You've got a pension. So this concept is something that you don't relish. What can you do? Well, handily, you can incorporate a business by transferring the assets into a company in exchange for shares in that company in a way which doesn't trigger any capital gains tax. And if you're starting from a partnership position, it should not trigger any stamp duty land tax either. It is a very, very important and powerful planning point. The shares that you get in the company don't actually have to be ordinary shares. So you could weave in a bit of inheritance tax planning at this stage if you wanted to. You could arrange for a company to be created with, let's say, your children as the shareholders who own the ordinary shares, and you could receive redeemable preference shares in exchange for the properties that you transfer in. So at the very worst, you would freeze the value of your interest in the company because the increasing value of the company would accrue to the ordinary shareholders, and you could over time redeem the shares in a manner which would put you in the capital gains tax net. So that is a very powerful planning point. There's another incredibly attractive twist to it, which is this. If you are sitting on a personally owned property investment portfolio, in respect of which the properties are pregnant with gain, and you think, I'd rather sell properties 1, 2 and 3 because they're underperforming, and go and buy properties 11, 12, 13, if you do it yourself, you'll trigger a gain. And you won't get rollover relief because it's an investment business. So you'll have to pay the capital gains tax. If you transfer the properties to the company in the manner I've described, the company is deemed to acquire them at their market value. You get a tax-free uplift for capital gains tax purposes at the company level. The asset that was pregnant with gain in your hands is no longer pregnant with gain in the company's hands. It is the shares that you own in the company that are pregnant with gain. So you continue personally to own an asset pregnant with gain, being the shares you've got, but the company has an asset which has been uplifted for capital gains tax purposes. So the company could then sell properties 1, 2 and 3 without triggering a gain and reinvest in properties 11, 12 and 13. So that is a very, very important point. Another twist, for those of you who are not domiciled in the UK, and in particular for those of you who are domiciled under general principles in India or Pakistan, is that if you do incorporate a property business in this manner, there is nothing to prevent the shares that you receive being in respect of a non-UK resident company. It's a very surprising relief. There is no territorial limit to it. So if you took shares in, let's say, a Jersey company, instead of your shares, instead of your properties, the properties clearly are UK situated assets, but the shares would not be UK situated assets. And then, under the terms of the UK Indian and UK Pakistani capital tax double tax treaty, those assets would be exempt from inheritance tax, even if you had been resident in the UK for donkey's years, so as to make you deemed to be domiciled in the UK for inheritance tax purposes. If under general law you're not domiciled, you can roll those properties into an offshore company. Very interesting point. Suppose you've got a trading entity. If you've got a trading entity and that, let's say, is throwing off large profits, again, same principles might apply. You might think, I don't want all this money, I don't need it all, I can't spend it all. I would rather accumulate it at corporation tax rates. So it would be a glorious opportunity to incorporate that trading business. Again, you could do it via this thing called Section 162. You could do it for shares. You don't need to. You could sell the goodwill to the company for a capital sum, transfer the other assets in. That would work well. You would then trigger a gain for capital gains tax purposes. What rate would be payable on that gain? 10%. assuming it's up to £10 million, from what Paul's just said. So you'd have a 10% capital gains tax liability. If the business that you were incorporating had started after the 1st of April 2002, the company would be able to write off the goodwill and get a tax deduction for so doing. So you would have an absolutely glorious, perfect tax position in that you would be paying tax at 10%, but the company wouldn't be paying tax on the equivalent income because it would be matching income to the amortization of the goodwill. Very important point, that. Very important point. So you would be purely getting money out of your company at 10% tax. If you said to me, that's all well and good, Wood, but I don't fancy the idea of triggering a huge capital gains tax liability on day one when I've got no money to pay it, hoping that the company will trade profitably. I want a bit of a guarantee in this regard. I will say to you, fear not. I can give you that guarantee because you could transfer the business in exchange for redeemable shares, and then as money became available in the company, redeem the shares. You would then trigger the gain when you had the money. It's a very, very important point. So think on. If you haven't understood what I'm saying, don't worry. It's all very technical, all very complicated. Just talk to one of us afterwards and we'll explain. But incorporating a business, whether it's an investment business or a trading business, gives rise potentially to some very interesting opportunities. If you are starting with a partnership or an LLP, think about introducing a corporate member. That way some profits can be allocated to an entity which will only be taxed at 26% at the most on it. If you want to know whether that's the sort of thing a gentleman should do, look no further. This person, whether this means gentlemen don't do it or do it, I'll leave that for you to decide. But if you look at the bottom of the Barnes Rove LLP note paper, you will see that there is a member, which is a company. If you're going the other way, here's an interesting thought, the final point. Supposing you're starting with a corporate group, one thing that you will have been noticing in your corporate group is that as you provide benefits in kind, cars for instance, to your directors and employees, and as you pay salaries to your directors and employees, there's huge amounts of national insurance contributions, so all these sort of benefits, national insurance costs are getting bigger. They're not getting any better, they're getting worse. There is nothing to stop you introducing into your group another entity, another corporate entity, which is an LLP, that isn't a limited company. And that LLP could provide services round the group. It could run the cars for the employees, for instance. And if those employees were members of the LLP, lo and behold, what would you do? You would save a hell of a lot of employers' national insurance contributions, and you would put the employees in a far more benign regime vis-a-vis benefits in kind, i.e. if you're self-employed, there isn't a benefit in kind regime, there is a disallowance of some of the costs attributed to the car, whereas if you've got a company car, the amount of tax that is paid bears no relationship whatsoever to the economic cost of providing the benefit or the economic benefit of receiving the benefit. So think about that. Very interesting point. Right, quickly, a few more. Still no NIC on dividends. Well, for how much longer? I've always said, oh, it's bound to change, it's bound to change, it's bound to change. I've been saying that for at least 10 years. And what did we hear yesterday in the blurb? That if they are going to merge tax and national insurance contributions, it's not going to affect the non-national insurance ability of dividends. I think, good heavens. With national insurance rates going north from the 6th of April 2011, and with corporation tax rates heading south from the same date, or if you're a purist, from the 1st of April 2011. The attraction of having dividends, very straightforward point, it's just cheaper. If you take a salary, you will pay more tax and national insurance contributions, and you will get less in your pocket than if you took a dividend out of a company. Just full stop, end of story. And now the figures have got better. So very straightforward. If you want to twist it a bit, how easy is it to spread dividends around? One thing you don't want to do is pay 50% tax, which means having income of £150,000 or more. Dividends don't aren't taxed that way. I know before you howl me down and say dividends don't pay 50% tax, it's only 42.5%. Yeah, I know, but the effect is the same. It's a funny way dividends are taxed. But you could spread the income around by using trust arrangements so that you still have control over the shares, or by making gifts to people that you trust, or by holding shares jointly with people that you might trust. Transferring assets to spouses is obviously very easy, no capital gains tax, no inheritance tax. Transferring assets to trusts or to other people isn't quite so easy, but if you're dealing with a trading company, there are reliefs. You should be able to claim capital gains tax holdover relief, you should be able to get the benefit of inheritance tax business property relief, so you should be able to do it. You should be able to spread the dividends around. Not too difficult. Here's a more wacky one. This is not for widows and orphans, I suppose, not for the uninitiated. It is possible, it seems to us, and it seems to a learned counsel that we have consulted, that if you do stick an LLP into a corporate group, and if you do structure income streams in the right way, and if you do have profit sharing agreements that say the right thing and are implemented in the appropriate manner, that you should be able to exploit the difference, the mismatch that applies with partnerships stroke LLPs, under which, as a member, you do not pay tax on what you draw, you pay tax on the profit share that is allocated to you. So if you can put in place some kind of structure that enables rather more drawings to be channeled your way than the profit share that underlies that, you could be in a very happy position. And the way you do that is by blending together at least one LLP with possibly two or more companies and having different streams of income. Some of that income will be dividend in nature, some of that income will be trading in nature, and carving it between the members in a fairly imaginative way. So if you want more on that, come and talk to me afterwards. Final point on that slide, quite a straightforward one, which Paul has just touched on, really, so I'm not sure I need to say anything else, but it is stating the bleeding obvious, is it not, that if you were coming up to retirement and you had a shareholding in a company and your co-directors, co-shareholders, and you had an understanding that, yes, you were going to retire in 3 or 4 years' time, let's say, and generally, yes, you take all the income out by way of dividend, surely you would think to yourself, if I'm a higher rate taxpayer, let's say a 50% taxpayer, with a dividend, the net tax you pay, for reasons I can't possibly begin to explain at this stage of the afternoon, is 36.11%. But if the company bought in your shares and you qualified for entrepreneur relief, it would only be 10%. Well, it doesn't take a genius to think, well, for the last few years, let's just sort of stockpile my share of the pot, and then I'll get my share of the pot out by the company buying in my shares. I will then be a 10% taxpayer rather than a 36.11% taxpayer. Can't be easier. The rules on business assets for CGT purposes, Paul has explained to us. So I won't dwell on it. I will just observe that if you are going to sell your company for a gain of, let us say, £30 million, and there is you, there is your spouse, and then there is your ungrateful and ingracious son, if you spread the shares in the right way, the whole 30 million will be taxed at 10%. Because of entrepreneur relief being a per person thing, if you've got enough people and you can spread the shares in the right way, you can fill your boots. So, that is a very easy planning point. Paul alluded to more sophisticated planning points. I won't go into them. For inheritance tax purposes, I always get to this point, and I never quite have enough time to go into these final 2 points in great detail. So if you want to talk about inheritance tax, come and talk to me. But let me say just the 2 things. If you own shares in the right kind of asset, which is businesses, agricultural assets, farms, that sort of thing, there is no inheritance tax on it. Everybody knows that. This is not a revelation to anybody. What is a revelation is that the rules regarding those type of assets are quite benign. You can, for instance, envelop what are inherently investment assets within trading stroke agricultural structures, and for the relief that attaches to those structures to swamp your investment asset. That is one point. Another point is that on death, it is possible to what they call double dip these reliefs. What that involves is settling the assets with the business property relief on a trust, which you can do tax-free, then leaving, let's say, cash to your surviving spouse, who, with suitable advice and at the appropriate time, will swap the cash for the business property assets. What then happens is, when she dies, she doesn't have any cash. But what she's got is business property assets which don't suffer inheritance tax. The cash has been got into the trust. And okay, if the trust runs and runs and runs, you'll pick up 10-year charges. But if both people drop dead in, reasonably quick succession, and I'm not suggesting that that is the planning opportunity that you should be saying to the surviving spouse, you don't hand over the poison pill marked open in 2 years or anything like that. But if that were to happen, you wouldn't pick up these 10-year charges, and you would blow out 40% inheritance tax and replace it with a very small exit charge. It might be a few percent. And finally, this is a very, very, very interesting point here. There is a most peculiar relief in the inheritance tax code called Section 28. And it says that if you transfer shares in a company to a trust established for the benefit of employees in the right way, that is exempt from inheritance tax. Surprisingly, it doesn't say it's got to be a trading company. Surprisingly, the relief is not predicated about the shares qualifying for something like business property relief. It could be an investment company. There are funny rules that say, oh, but if the beneficiaries are connected with a participator, you don't get the relief. And people will say, oh, you fool wood, you've sold us right down the line here. We've done this, and of course we're connected with the participator. It won't work for us. And I say to you, fear not, because what's going to happen is you're going to do it when you're dead. You are going to hold those shares in those investment companies, and you are going to die with them, and you are going to bequeath them to this rather peculiar trust. And guess what? A dead person can't be connected with anybody. Dead people don't talk, and dead people aren't connected. So as a way of washing out gains for value for inheritance tax purposes on investment type assets, think very carefully about using the rather peculiar, little understood, but very generous relief for employee trusts. And obviously, I haven't said it, yes, the employees will be your children. So, on that happy note, talking about death and taxes, one of the few things I like to do, can I invite you to shuffle out that door there, turn left again, and join us for a sandwich and a bottle of cheap wine or whatever we can lay on. Thank you very much. Thank you for listening.